You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate and property management expert, Josh Weidman. Now, for more than a decade, Josh has been an active investor and real estate entrepreneur. Josh built his very first real estate business by wholesaling Philadelphia row houses, and shortly thereafter, he and his partners built and grew Atlas Property Management Company into a multi-million-dollar firm and later sold to TCS Management Services. In 2018, Josh joined TCS Investment Group, bringing his expertise in marketing, construction, and business development to the TCS team. And one of the unique and valuable skills that Josh brought over to the TCS team, and one that we'll be spending a lot of time discussing today, is where he takes single-family residences in inner-city Philadelphia and converts them to 3- and 4-unit apartment buildings. Now, not only is he converting to a higher and better use, but on a regular basis, he's also receiving about 100% rent premium over what that unit would have rented for as a single-family residence. In addition to that, now that when he has a vacancy, he still has other units paying down the mortgage and handling the expenses, which is really the beauty of multifamily properties in general. It's one of the many beauties of multifamily properties. And so in a standard single-family arrangement, for those of you out there that have single-family rentals, when you have a vacancy, you have zero cash flow, okay? So that's not a good thing, but it's a good thing when you've got other folks still covering the mortgage and the debt, even when you have a unit that might be sitting there empty. And so in this interview with Josh, here's what you're going to learn. You're going to learn how Josh built a large-scale property management company that he later sold to a much larger competitor. You're going to learn about the challenges that Josh faced as he scaled his property management business and how he overcame them. You're going to learn the good, the bad, and the ugly of running your very own property management business. You're going to learn about the value that Josh saw in not only selling his business to a competitor, but also joining their team as a principal. You're going to learn about the unique strategy that we just chatted about, where he takes single-family residences and he adds huge value by converting them into 3- and 4-unit multifamily properties. You're going to learn about how he identifies these properties that have specific zoning that will support such conversions. You're going to learn about the typical rental premium that he receives on a fully converted multi-unit from its original single-family state. As I'd mentioned, most of the time he's getting 100% rent premium over a single-family residence converting it to a 3- or 4-unit property. That's huge, guys. That's absolutely huge, okay? So we're going to have a great discussion with him today, cover many other topics in addition to the things I just mentioned there. And so I'm excited to get onto this show with Josh. But before we do, I just have a few quick housekeeping items I'd like to run through. First and foremost, my personal best. This is the new segment we started about a month ago where I share with you my one personal best and my one professional best of the prior week. Now, as far as the personal best, we recently just signed up my oldest son, Jackson, for an after-school taekwondo program. And he actually just had his very first introductory class a couple days ago, in which my wife and we got to attend. It was absolutely awesome watching Jackson interact and engage with all the other kids in there and also with the sensei. It was pretty cool because some of these munchkins, these little kids are like, 4 and 5 years old. They were absolutely badass. There was this one little boy, I think he was probably 4 or 5. He was absolutely badass, man. He's probably been doing it for a number of months or maybe even a couple of years now because it seemed like he was pretty talented. So I'm very much looking forward to really the personal development that will come from Jackson's time spent in this program. And there's a lot of discipline that's taught, and I think it's going to be really good for his self-esteem, his confidence. I think it's a perfect timing to get him enrolled in something such as this. So very excited for that. Now, as far as the professional best, as I'd mentioned a couple of weeks ago, my business partner Brian Spear, he got married. He tied the knot, and so he immediately went on his honeymoon thereafter. He went on a 2-week-long cruise in the Mediterranean, and so he just got back. And so it's good to have him back here. It's good to have his energy back into the office here. And I know that Brian actually listens into the show sometimes. And so, buddy, we're glad to have you back, man. And Brian, if you're listening, we're glad to have you back. Alrighty, guys, moving on here. If you love what we're doing here in the show, be sure to take a minute, go over to iTunes, subscribe if you haven't done so already so that you can be notified whenever a new episode comes out. In addition, leave a rating and review if you truly love what we're doing here on the show and you feel like it adds value to you and your business. And like I do every week, I'd like to give a shout out to someone that's taking the time to leave a review. And this review here is from J Diaz 30. And so J Diaz says, I have been listening to Kevin's podcast for several months now, and the content continues to be of the highest quality. This is not my first review, and I doubt it will be my last. I just had to give another review just to spread the word about how good this is. I've yet to do a large multifamily deal, but podcasts like this definitely help point me in the right direction. And I love the idea of mobile home park niche as my first multifamily investment. So Jay Diaz, I don't know what your first name is, Jay Diaz. I really appreciate you taking the time to leave the review. It's greatly appreciated. I love that we're helping you in your business. And again, folks, if you haven't done so already, please take the time to leave a review for us, and I'll be sure to give you a shout out in a future episode. Last thing here before we get on to this show with Josh, just want to remind you about the free 30-minute call that I offer each and every week. I set aside 3 30-minute time slots where you can basically get on the phone with me and ask me anything your heart desires regarding real estate investing, okay? If you'd like to schedule that call, you can go to my website, kevinbupp.com, and just go ahead and click on the link that says schedule a call with Kevin, and it'll take you to my calendar, pick a time that best works for you, and we'll get on the horn together, okay? Just real quick to clarify here, because I get a lot of questions about this. There's no sales pitch here. I'm not going to try to pitch you on a coaching program or try to sign you up for an investment or anything like that. This is just my way of giving back and my way of connecting with our listeners. So I look forward to hopefully connecting with you here soon. Now, guys, without further ado, let's get on to the show with Josh. So here we go. All right, guys, it is my honor to introduce my guest for today's show, partner and principal at TCS Investment Group, Josh Weidman. Josh, how you doing today, my friend?
I'm doing fantastic, Kevin. Thanks so much for having me on. I'm psyched to talk about some real estate.
Yeah, absolutely. That's what we do here all day, every day. I think that's what you do as well. So
That's right.
You've been in this space quite some time based on your bio. You've done a little bit of everything. We're going to cover some very interesting topics here today. But, for those folks, Josh, that aren't familiar with you and your investment group, maybe, take a few minutes, tell us a little more about yourself and ultimately what got you into real estate in the first place.
Sure. Absolutely. So it's kind of interesting. When I was 16, I saw, like a lot of people, I saw the ad for Carlton Sheets, the no money down system.
Oh, boy.
And, it was,
I remember.
It was my first introduction, right? It's like no money down. I could buy a house with no money. That's amazing. So, I jumped on it. I was like, all right, this sounds great. I ended up buying it. It's like, $95, scraped some money together, bought the thing. And like most people, threw it in the closet and didn't do anything with it. It's like, I've listened to a couple tapes and all that. And that was the end of it. Fast forward, I was in my mid-20s and I had a construction company that I was just done with. I was closing it down and really wasn't sure what I wanted to do with my life, and looked around. I was like, you know what? If I was going to get into this real estate thing, I'm going to give it a try. And with a partner, we bought 3 houses to flip in a 3-month period, started the renovations, and, a beautiful thing happened. We had this downturn in the economy that, almost, a huge drop in housing prices and all this kind of stuff. And it was kind of the beginning of the downturn. And I had these 3 houses on the market, lost money on all 3 of them. And it was a really bad experience. It was a bad intro. Thankfully, while they're on the market, I get a call from a guy who used to work for me in my construction company. He says, hey, I know you probably didn't know this, but I'm a cocaine addict. I just got out of rehab, haven't paid my mortgage in 6 months, and I heard you're buying houses. Can you come over and give me an offer? And, kind of shocked me, but, I went over to his house, looked at the place. It was like the worst house in the best neighborhood. It's like the dream house, the terrible house in the bad neighborhood with tons of equity, And so we end up signing a contract, and I'm walking out of the house and I'm thinking to myself, man, I don't know what I'm going to do with this house. I got all this money in these 3 properties that I'm rehabbing, but I was introduced to this concept called wholesaling, and wholesale the property, made $30,000 on my first deal. And I was like, yep, this I can do all day. And so with a business partner, we built We Buy Homes to Fix. It was a wholesale company here in Philadelphia, became one of the biggest wholesalers in Philly. And from there, when when the market got really bad in like 2010, end of 2009, beginning of 2010, we were kind of at the bottom of the market. And at that point, just couldn't make any money on wholesaling. People were giving us their houses and there wasn't enough equity to flip it. So it's like, all right. At that point, same partner and I, we started a property management company. We had these rentals and figured, hey, we're doing okay with our rentals. Let's build this business. And over the course of the next 5 years, went from our own 20 some odd units to 630 some units, and learned that business along the way. It was kind of an interesting experience. But then along the way, I had this Israeli airline pilot show up in my office, and he said, I've been buying properties in Florida for the last couple of years. The market's getting a little better there. The prices are a little higher. And I've been looking at Philadelphia. Here's what I'd like to do. I want you to find me some houses. I'll buy them. I'll pay for the renovation. You guys lease them out and manage them. Sounds like an idea. And so I sent him a list of a few wholesale properties. He looks at me, buys one, renovate it, lease it out. And then he did 2 and then 4. And before you know it, we're, I don't know, a year in, he's bought 20 or 30 properties from me. And I'm going, man, it's pretty nice business. And so that kind of ended up being a transition into the turnkey business from property management. I sold the management company in 2015 to TCS Management, and kind of went through a couple derivations of the turnkey model and to come to where we are today with TCS Investments. We are the investment side, and we have a management company on the other side of our office. So it's kind of, it's been a long journey. It's been an interesting journey, and learned a lot along the way.
Okay, good deal. Good deal. So I want to back up a little bit. I want to dissect a little bit of what you just mentioned. That basically spanned, I guess that spanned about 6 years or 7 years or something. Well, yeah. So you started buying when? You started actual buying real estate in what year? 2006, 2007 or? 2000.
No, later than that. I got involved in real estate in December of 2006. So the spring, of course, I bought in all subprime markets, and so, we kind of saw the beginnings of the 2008 crash in the spring of 2007. And that was kind of my intro. And, that's kind of how I got started. Okay. So we started actually acquiring real estate. I think I bought our first property in late 2008. And it was the kind of thing where it was like the people just wanted to get out of the mortgage. They were scared, and we just assumed the mortgage. I think that was the first, that was our first purchase. And then from there, it was like, hey, we're making money on cash flow. Let's just keep going. And okay, it's pretty interesting.
Let's talk about the building of the property management company. That I always felt that the property management side of the business, and I've built many years ago. We owned hundreds of single family properties and hundreds of multifamily properties, and it was a necessary evil that we built the property management in house. We had tested multiple different times. We had tested a few different local property management companies. We'd hand them a handful or two of properties just to see how they would do, because it was one of those businesses that wasn't incredibly profitable. It was very thin margins, lots of staff, just lots of moving parts with it. And it's very hard to scale, at least in a manner to where it becomes incredibly profitable, that you're excited every day to come in and actually say, I'm running this property management company. And so it's a necessary evil. And so I really want to hear from your perspective of, you built it because you had to, but how you went about scaling it from, your own properties ultimately to, 630 residential units. I mean, it's a fairly decent sized property management company. There's lots of, challenges you faced along the way. Just even building out the standard operating procedures, right? The systems and processes that basically are the core of the business that make things run efficiently, budget controls, finding reliable and affordable labor, which is its own challenge in and of itself. And so if you could, maybe give us some insight as to what that time frame looked like and ultimately, some of those big challenges you faced and how you overcame them. Yeah.
So that's a big question.
All right, yeah, it is. I know there's a lot here. You might as well just share the entire business model with us. Exactly what that looks like.
I'm happy to. Yeah. Hey, I sold the company. I'll give you all the details, right?
And the beautiful thing is that you exited out of it. So you obviously built it properly to where another company was willing to come in and take it. So it wasn't a complete disaster, right? It wasn't this mess of a company. You guys had some organization structure there to where it was clean enough to where you had another company that saw the opportunity there to come and purchase you.
I'll tell you what, the best move that we made was to bring in 2 other partners. They were minority partners, and they did it almost as a gift. I know it sounds a little crazy, but I was building an info business, a real estate information and education business with 2 other partners. These guys had really, really good knowledge on how to build the structure of a company, how to build it out in a way that, everybody's secure and comfortable with their responsibilities, and there's no question of who's responsible for what, and that's really what you need. And so they came in as small partners just to kind of help us organize things, and it changed everything. And with property management, you end up with 2 basic types of models. You have the departmental model, where, you've got the accounting department and you've got the maintenance department and, tenant affairs and, a contact for the owners, all that kind of stuff. And then on the flip side, you've got more the model where you've got one property manager responsible for, say, 100 properties, and they lease them. and they collect the rents if they need to. And if there's a maintenance call, they take that maintenance call. We started with that type of management and realized very quickly, yeah, right, you're only as good as your weakest link, right? And that was something that it was a necessary evil when we were managing 100 properties, right? Because you can't pay for 5 people to manage that type of, that small portfolio. Mm-hmm. But as we grew, it became really obvious that if we didn't have one person responsible for a very defined, scope of work in their job, we'd never get anything done and nobody would be accountable. It was like a slap in the face when me and my partner were doing the exact same job every day. And, we found out we're emailing the same owner, 2 different answers to the same question. That becomes a major, and it was a big eye opener. But by breaking out the company into our departments, finding the right people to put into those spots, and, the people part of it was, that's a whole nother story we could spend hours on. But, for me, the biggest change with hiring was realizing that, number one, you get what you pay for. And number 2, if you don't know what the role is, you're not going to hire the right person because you don't know what the heck they're going to be doing. And so that really was part of a big managerial learning process for me. In the beginning, it was like, hey, we need more help. Let's go hire somebody. Instead of, we need more help doing these specific things. Mm-hmm. What's the person that does these things? What do they look like? And what do they sound like? And, what kind of personality are they going to have? And what do they have to bring to the table? By changing kind of the perspective there, it really changed the type of people that we were able to bring into our organization. And
so what did that process look like? So you brought in those two minority partners that had a lot of experience with building other types of companies, not necessarily property management companies. And so there had to have been a exploratory period of time to where they had to basically extract all the relevant information from you guys and, make sense of it and then organize it into a business. And so what did that even look like? I mean, because I'm assuming going from the one hat, manages multiple different roles model, you guys still, there was a lot of voids that you probably didn't even realize existed, or you did realize, but you didn't know what they were necessarily. And so there was probably lots of missing that you had to fill in. And so just give me an idea what that process looked like and how long did it actually take for you to get something more organized in place?
Well, so the first thing to keep in mind is that the 80-20 rule is 100% accurate, and most of the time we worry about that 20%. It's like the little tiny thing that happens twice a year that we spend 2 weeks putting together a process for. But the phone call that comes every single day, just, nobody worries about that. And so what we did was we started with, all right, we're going to pretend that we have no clients. First of all, how do we get clients? All right. So we have to get the phone to ring. And once the phone rings, where's it go? Who's going to talk to them once the phone rings? And then from there, we took it through as if we had one client with one property, took it through a vacant property and just laid out, these are the things that are likely to happen on, 80% of our leases are managed properties. Mm-hmm. And we just sketched it out. Here's what needs to happen. Here's what we'd like to happen. And so we started with, here's what needs to happen. And it's like, okay, here's what needs to happen. Can we break these necessary activities into different roles? You've got a property manager that is responsible for collecting rents and handling maintenance calls. Yeah, okay, one role. Anything that is related to that goes with them. Is this collecting money, paying bills, anything? Okay, that's probably accounting. Let's put it in script. And so we did that step by step in it. And really, we spent a couple of weekends in Atlantic City. We spent some weekends in Baltimore and just basically locking ourselves in a suite with a whiteboard and taking a lot of, pictures of the whiteboard and then backing that out into deliverable actions where it's like, okay, now we're going to look and really we started with the things that were the biggest headaches and the things that, would take up all the time, that if we had a small process involved and we had the right person in place, nobody would even think about it again. And so it was like, it started there with the biggest pain points. Then we really had to do it all over again. Because once you get the system down, you realize the system's not quite right. And so a couple tweaks, but I mean, it took, it's a great question. It took 2 years until it was to the point where it really ran pretty smoothly. And I think the pivotal point in that final transition was a switch of roles between my partner and I. And like I had been kind of running the company, and I'd become so absorbed in everything that was going on that I didn't have the high level view to be able to make some decisions that needed to be made. And so we just said, I mean, literally I can remember we went out to dinner in Baltimore with all the partners, and I was like, look, something's not right here. And so he stepped in and became basically the operating partner. And I was more involved with sales, and it really, just clicked and was the right thing for us. But,
okay. Yeah. Good deal. So even after all that time and energy and effort put into building the company, still decided at some point that it made sense to sell. So that's ultimately where it brought us to today. However, we don't need
happiest day of my life.
Yeah. I bet. And we don't have to get into the weeds there, but ultimately, congrats on your success of actually putting together the systems and the processes. Again, it's not an easy feat to actually take on and actually build something that runs smoothly. And so kudos to you for that. And then ultimately selling on the backside. And now I want to switch gears a little bit if we can, Josh. And prior to us jumping on the call here, we chat a little bit about this little unique, niche, you could say. And I'm sure that it exists in other larger cities, just like a Philadelphia where you're based out of. And that is the niche of taking a single family residence that has an underlying zoning that can support a multifamily density and actually converting that single family into a 3 or 4 unit property. And that's something that you guys have somewhat perfected and have done many times over and over again. And so I don't want to butcher it here. And so maybe if you could just give us some general insight as to what that business model looks like and ultimately how do you guys identify these opportunities?
Sure. It's a great question. So I got to give a little bit of background here, and that our core business is, we do single-family turnkey investments for either pre-construction or post-construction. We got a lot of requests from our clients about multifamily. It's not necessarily 20, 30 units, but 3, 4, 5 units, 2 and 3. And what we were finding is that it became more and more and more difficult to buy these things at a point where the cash flow made any sense. Philadelphia is kind of an interesting city in that it's an old city. We're an East Coast, blue collar city that. Right now, really, we're in the Rust Belt, right? So our houses are pretty old. And so when we go in and we're renovating these houses, almost all the time, we're talking about gutting everything. We might keep some framing on the second floor, but everything from top to bottom is new. And so when we're going into these properties, we're looking at the renovation costs and the acquisition for these multifamilies. It's just astronomical. And then we stumbled on our first RM1 zoning. And RM1 is a high density zoning. It's in Philadelphia, and it may be used around the country in different cities. But for Philadelphia, an RM1 zoning allows you to convert to change the use of the building from a single family to a multifamily. So if you have that zoning and you have a property that, let's say it's 2,500 square feet, which isn't uncommon, we can take that 2,500 square foot single family, gut the thing, and rebuild it as a 3-unit building. And we can do it at a price point that makes a heck of a lot more sense than buying a triplex, gutting it, and rebuilding it. Mm-hmm. And so, it just, the numbers make sense. We're able to do a lot of value add construction. And because of the demand on these smaller multifamilies, we're able to really, add $150,000 in value just through the conversion. So, it's been really successful for us, and it's been something that has been really in high demand. The choke point for us is finding enough properties to fill the demand.
Interesting. And so I'm guessing that once you convert it from a single family, which typically, get valued on a comparable sales approach to a multifamily property, are you essentially transitioning over to an income approach at that point in time as far as the valuation of the property?
So it depends on the number of units. We've been able to have the income approach used to evaluate triplexes and 4 units. We've not been successful to do that on our duplex conversions. However, the comparable sales for multi-units, they tend to be 15 to 50% higher than single families, depending on the market, depending on the neighborhood.
And then let's use the example of converting it, the one that you shared, from a single family to a triplex. What kind of rent premium could one expect, given that model, from what you might get as a fully renovated single family property to a renovated? I'm assuming you probably get 3 1-1s out of it. Are they 1 bedroom, 1 bath that you might get?
No, there's 3 2-bedroom, 1 bathroom.
Wow.
And so they're smaller units. They're close to the University of Pennsylvania, this property that I'm thinking of specifically. It's kind of on the outskirts of student housing. So, when we looked at it, we said, okay, if we can get student housing in here, that's great. We can probably get about $1,300 to $1,500 per unit. But if we get a market rate tenant, we're still looking at about $1,200. So we based it on the $1,200 per unit per month, and then you look at it as a single family home. The value of the property there is certainly not in the cash flow, because you might be able to get $1,800 a month for a single family home.
It's almost double that.
It's just not as much
more than double. Yeah, you're getting more than double that.
More than double. Absolutely. And beyond that, I don't want to rent that house as a single family. As a 6-bedroom house, I'm going to have a lot of people living in there. And in this neighborhood, we're looking at probably B-, C+ market rate tenants. So we're talking about large family, large house. Mm-hmm. It's going to get beat up, and as opposed to a triplex where you probably have 2 young adults or a couple living in each apartment, and it's typically a little higher income, more disposable income. And if they're students, we've got a cosigner on the leases. So it's just,
mom and dad. That's always a good thing.
There we go. Exactly. Right. So, that combination, it really is a no-brainer. Now, on a flip side, if I was flipping the house, yeah, a single family is going to sell a lot better than maybe a triplex would in that specific instance. But most of the time, when we're looking at these RM and high density zonings, they're in areas where the comparable single families are significantly lower.
Very interesting. Talk to me about the rehab cost. I'm assuming when you're converting it to 3 apartments, or you're making a triplex out of a single family, you got to add 2 additional kitchens. You got to add, heating and air conditioning units. There's a lot of additional infrastructure that has to get put in place. So,
there is.
The cost of renovations from if it was just renovating that single family property to converting it to the triplex. Give me an idea of what that looks like, the comparison.
On this specific property, it's about double, which so on a single family, 2,500 square feet, that renovation is going to cost us about $100,000. Give or take about $5,000 on either side. We're going to be able to come in with a retail ready product or a rental ready product for a higher end rental at about $100,000. When we go to a multi-unit, we're going to finish out this project at about $185,000. So, it is more expensive on the renovation side. That's why the purchase price really matters, and the acquisition obviously is part of every deal. And so, the renovations are higher, but you're all in on that property. I believe the total investment was $315,000. When we started the project last fall, it was, we figured a $400,000 valuation. At this point, it's about $550,000. So, that part of the market is really going crazy, but we've got our final inspection with the city scheduled for the end of this week. So it's about a 9-month project. And
Yeah, I'm assuming this zoning exists in other densely populated metros. It's got to. Maybe it's not the RM1, but it's something similar, right? The same idea behind it. Have you guys ever done a search to see exactly how many RM1 zonings exist within the confines of Philadelphia?
It's thousands. It's not thousands. It's tens of thousands. You've got whole areas of the city where you've got 20 by 20 block, 400 blocks worth of properties that this whole area is RM zoning, RM1, or there's also a mixed use zoning that allows you to convert from, a building with let's say a deli or something on the first floor and an apartment above to 2 apartments. There's all kinds of different zoning nuances and they exist in every municipality. The real key, if you can learn some of the loopholes there, these are deals that a lot of times other investors are looking at and saying, no, this is too expensive, or this is not, it's too big for a single family, or it's this or that. If you know what you can create from that structure, you can add value all over the place.
I was going to say that's why great developers are visionaries. That's what we're talking about here. It's being able to see the higher and better use in something that has one purpose today, but ultimately has a much higher and better purpose, tomorrow. And that's what we're talking about here. And that exists whether you're in single family properties or commercial properties. You see change of uses all the time, but it's all about having that vision to see not what's there today, but what's really possible tomorrow.
and to see the impact that this kind of thing can have on the neighborhood.
Mm-hmm.
I mean, this is what I look at, is that, you go around Philadelphia, and because the city is so old, and because honestly, there are areas that have been ignored for decades. We've got some areas of the city where we have 2 or 3 houses on the block that are just boarded up shells. If we can find a way to capitalize on that, I mean, that has a huge impact on that block, on that neighborhood, and, on the city as a whole. I'm not trying to, trump this up too much, but really by converting a lot of these properties to functional spaces, it provides a lot of opportunity in the neighbors for continued development, and really just, it's like the broken window theory. You got a broken window on a house. If it gets fixed, nobody cares. If it's like that, you leave it like that, and somebody comes by and they're throwing trash in the house and kicking in the door, and before you know it, the whole neighborhood looks like crap.
So what's the scalability of this business model? I mean, have you guys actually looked at it in the manner of like, hey, let's start aggressively targeting all these different RM1 zonings like throughout the city or whatever your target region is?
Yes, we have. And
okay.
Well, so we have a small geographic area that we target. And what we try to do with any of our investments is look at areas that they're in the midst of transition, not at the very beginning where you're taking all the risk, and not at the end where you're not, there's no upside. Mm-hmm. But we're looking for things where you can kind of see the progression of the neighborhood. You can see the investment the city's making into the infrastructure upgrades and things like that, and look at, the value trends and reasons why neighborhoods are changing. We identify 1 to 2 neighborhoods on, we look at it quarterly, but 1 to 2 neighborhoods a year, because what we see is that we're able to get people in at a price where, there's a lot of upside, and, kind of ride the wave to the point where, okay, it no longer makes sense on a cash flow perspective. In the beginning, we get a lot of cash flow, and, over a 2-3 year period, we've seen a lot of appreciation in our investments. So to answer your question specifically, scalability, yeah, it's definitely something that we look at. Anytime we go into a new neighborhood, we're definitely looking at these high density zonings within these, geographical confines, and, marketing to those people and targeting those houses for sure.
And then I'm guessing from a buyer's perspective, at least your business model, I know a lot of this you keep for yourself, but you guys also, will create these conversions, and then some as a turnkey opportunity to some of your clients. I mean, at that point, they qualify for conventional financing, which is a beautiful thing because they're, under 5 units or 4 units or less.
That's right.
So you get some beautiful debt on them as well, 30-year fixed.
That's right. You know what? There's some really nice 30-year fixed, even for commercial, coming out on the market that have been
really
maybe not for the largest. Yeah. I mean, they're about 1.5 points higher on interest rates than a conventional loan, but with a 30-year fixed, a lot of times it makes sense on the cash flow side.
Well, I know on the larger stuff, once you get to Fannie Mae's got some small loan balance programs, and you got Freddie Mac as well. You can get 30-year, 30-year amortization, but, typically like 10 or 12-year fixed term, sometimes up to 15. But yeah, typically it's like that 5, 16 or 20 unit properties always kind of fell by the wayside. It's, typically like a local bank or regional bank, and it's 20-year amortization, 5-year term. It's, higher than conventional rates. And it's never all that attractive. But that's good to hear that there's actually some different debt that's available nowadays for the serving kind of that void that exists. What are some of the challenges that in this business model? I mean, what are some of the folks that are listening in, like whether they're in Philadelphia or any other major city throughout the U.S. that want to explore? Really the opportunity here is in the underlying zoning, right? Again, being able to see something that many others do not. What are some of the challenges or risks that you feel are associated with going after this business model?
Well, you really have to know the zoning. I mean, every municipality is different, and in 2012, Philadelphia completely rewrote their zoning code. And so it was, like hitting the reset button, and I had to learn all the information over again and kind of see some of the connections. But that's not a bad thing. I mean, the nice thing that we have today, as opposed to 30 years ago, we have the internet. We've got all this information at our fingertips. You want to know about the zoning code in, we were talking earlier, you said you're from Harrisburg. I'm from Hershey. I guarantee you the zoning code in Harrisburg and Hershey are different. But within the next 15 minutes, we could probably search on the internet and get the code book for both municipalities and be able to read through it. And it's dry and it's boring, but it's like gold. That's why there's so little competition in doing this type of stuff, is that nobody takes the time and nobody wants to become the expert. And really, you don't have to be an expert. Just read through the book. And if you have questions, go consult an architect. And, you can take somebody out to lunch that is an architect, or, pay him for a couple hours to kind of go through and explain the code and answer your questions. It's money well spent for sure.
Do you typically, with one of these conversions, do you typically get an architect involved to help with the reconfiguration?
Absolutely.
Yeah. Okay.
Absolutely. We do it more so not to lay out the building. That's something that we've really been good at in-house, but more so to go through all of the BS that goes with, with the township or municipality or whatever. These guys, they do this every day. Mm-hmm. You get somebody local, they're going to know the building inspector. They're going to know the person that's reviewing the plans. And if there's an issue, they're going to have the ability to pick up the phone and call them and say, hey, what do you really mean by this comment on on my plans?
Yep.
Having that connection, it saves you so much time and aggravation. And yes, it's going to cost you a couple $1,000s for plans and for the service, but it is money well spent. It will save you months of downtime when it comes to, getting through the construction process.
I know this is location specific, but what does that timing look like? You buy the single family property, you get an architect involved, get the renderings complete, get the overall plan completed, renderings approved. Now it's time to submit it to the city for approval. How long? Are they many months, or is it just a couple of weeks, couple of days?
Okay.
all
this is the above. So different. Okay. Well, all right. So I'm building a 3-unit. I'm doing a 3-unit conversion where I live. And that is, it's right outside the city, okay? It's not within Philadelphia proper. In Philadelphia, if we submit building plans, they tell us it's a 30-day review period. Within 30 days, they'll get back to us, issue permits, do whatever has to be done. Sounds reasonable. What really happens is we submit the plans, and on the 30th day, they send a response that says, hey, I didn't like the way this wall was, I want to see a double beam here, and I want you to add some insulation over there. So then that reopens everything, right? So it reopens the 30 days. You resubmit the plans. They have 30 days to review them again, and it ends up being 60 to 90 days till you can break ground and get working. In the suburbs, I submit my plans Monday, and by Friday they've been reviewed and approved. They're going to need all of my contractor information, and once they have that, we can start building. It's like totally different worlds. And, I've seen this on the flip side too, where you have a small municipality that has a guy that works 2 days a month, you know what I mean? And things don't get processed, and, you've got a more densely populated area that'll process things really quickly. So it really depends, I think, on the municipality. You really just have to do your homework. And it's unfortunate, but there's so much difference in even just a few miles.
Yeah, very interesting. Is rent control something you guys have to deal with in Philadelphia? I don't think so, right? I don't think they have Pennsylvania has rent control instituted. Okay.
No, that's not something that we've gone into.
Discussion. Pennsylvania as a whole is pretty much a conservative state. Is Philly, is it more blue or is it red?
It's very liberal.
Okay.
It's very liberal. Every couple years, the city council will bring up discussions that relate to being a landlord in the city. A few years ago, there was they tried to pass a law about lead-based paint abatement and testing that would have required every landlord in the city to, do $1,000 test every time the property turned over.
Oh my God.
And that's a killer. And so the nice thing about Philly is that we have the largest landlord advocacy group in the country. And, that law was shot down pretty quickly. And now, it morphed into something that is a reasonable concession for kids under 7, making sure that there's no active, lead dust in the air, and, reasonable things that everybody can agree is good for a tenant and good for a situation. And so about the rent control, it's been brought up in discussion. There's not been any legislation presented. I think there's enough smart people in the legislature that realize that will be a real killer if that gets introduced. But it just amazes me when you see when there's tax credits given to a certain area, people invest in that area. When you incentivize something, people go after it. When you penalize something, they're going to do the same thing. They'll run. It's nuts.
Yeah. Well, but you guys basically touched New York. So, and it's, I know. Mentioned, they just basically rewrote their rent control laws, and it's by far the most restrictive rent control in the country at this point. And it's it's a bear. It's unfortunate because New York was already in fairly bad shape as far as people leaving the state and going other places, and it's surely not going to bode well as far as attracting new residents or businesses and such to their state. So I wish them the best.
That's right.
Yeah.
That's why you're in Florida. It's perfect.
Yeah, exactly. Well, good deal, Josh. This has been an awesome time, man. Really appreciate you coming to the show. Now I like
my pleasure.
What I call the gold nugget segment of the show. This is where we're going to work to wrap things up as well. And what I'd like to ask of you, you've already shared a lot of gold nuggets thus far, but if you had just one final golden nugget of advice or wisdom left in your pocket that you could leave with our listeners that may inspire and motivate them as they progress in a real estate investing career, what would that one last gold nugget be?
The biggest gold nugget is to think long term. It's really easy to get caught up in the day-to-day and the minutia of bad things happening, good things happening, all that. But if you look at every opportunity as if, what will I think of this in 10 years, in 20 years, in 30 years? How will this decision impact me down the line? It'll change the way you make decisions. And for me, it certainly did for me. I mean, it was a big difference.
Yeah, that's fantastic advice. And, the interesting thing is I've interviewed hundreds of folks on this show, and there's been a number of interviewees that have been in real estate 40, 50 years. They maybe are in their 70s or even 80s. I think the oldest gentleman I interviewed in the show was like 93. He was a very interesting guy from Texas, had been a, oil baron, and then, owns, millions upon millions of square feet of real estate in Texas. And, of all these different, of folks that have been in real estate for a very long time, probably the biggest regret that they have is actually selling off their real estate too early, so it really is a long-term game. And typically you don't lose. Real estate's one of those investments that as long as you hold on long enough, you'll come out pretty far ahead. So
yeah.
Don't
panic.
No, don't panic. I mean, 2008 was a little rough. I admit we had some challenging times personally in our real estate portfolio. Sure. However, with that being said, it's still, even those properties that were challenged back then have since turned back around, have made a 180-degree turn, and are worth more today than what they were even at the height of the real estate market in 2006, 2007. So
that's right. That's right.
Yeah. Well, with that being said, Josh, this has been an absolute pleasure. Really appreciate you coming to the show. And folks, if you want to learn more about Josh and all the exciting things that he has going on, you can go visit him at realestatetheeasyway.com. Again, realestatetheeasyway.com. And Josh, thank you again. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.